Welcome to today's deep dive. When you picture the artificial intelligence boom, the images that come to mind are almost always entirely digital.
Right. It's all like glowing server racks and endless lines of code.
Exactly. We think of software that can just generate high-definition video out of thin air. There's this pervasive expectation that the AI revolution is just about clever programming. Like it's boundless, infinite, and completely disconnected from physical reality.
Yeah, it feels weightless. I mean, we literally talk about it existing in the cloud, which kind of suggests it doesn't take up any physical space at all.
But today, our mission for this deep dive is to completely shatter that illusion for you. Because the AI revolution is actually bound by some pretty brutal physical manufacturing
Oh,
limits.
absolutely.
And getting in on that growth requires incredibly complex financial instruments that carry hidden global risks. We're exploring the intersection of the massive AI hardware boom the financial wrappers use to trade these tech giants, and the incredibly thin line between physical reality and digital illusion.
It's a fascinating overlap, really.
It really is. And to figure out how this all fits together, we're pulling from a pretty diverse stack of sources today. We've got hard financial data from a Murray Asset Securities research report, some market coverage from Euronext and Fast Company, and strategic tech announcements from TrendForce and an NVIDIA press release.
We also have a regulatory paper from the European Securities and Markets Authority, or ESMA.
Right, the ESME paper.
Yeah.
And surprisingly, an article about a massive new magic venue in Chicago.
Which I know might sound like a total outlier to you right now.
Yeah, a magic show.
But the psychology of how we accept illusions in a magic show perfectly maps onto how we accept the digital and financial abstractions driving the global economy right now.
So you might think the AI revolution is just about clever software, but it is actually bound by physical manufacturing limits and traded through financial instruments that carry hidden global risks.
We really have to start with the physical foundation of the AI boom first.
Yeah, to understand the financial markets driving tech right now, we first have to understand the physical hardware bottleneck at the very bottom of the pyramid.
Yeah.
And that brings us to South Korea and a company called SK Hynix.
Right. So if NVIDIA makes the brain of the artificial intelligence, SK Hynix makes the short-term memory that allows that brain to function.
And that's the high bandwidth memory, right? The HBM.
Exactly, HBM. And right now, SK Hynix is experiencing financial growth that fundamentally breaks standard historical modeling for a hardware manufacturer.
I mean, the numbers in this Murray Asset Report are just staggering. They are projecting a 2026 operating profit for SK Hynix of 148 trillion won.
Which is just a massive figure.
It is. Their target valuation for the stock is 1,370,000 won. But the metric that really forces you to do a double take, at least for me, is their return on equity. It's sitting at 70.3%.
Yeah, that ROE is wild.
Right. For context, the peer average in their sector is around 36.9%. They are literally doubling the profitability
Oh, their closest rivals.
How does a hardware company even pull that off?
Well, the mechanism behind those numbers comes down to how operating leverage functions in semiconductor manufacturing. Building a chip fabrication plant, or a fab, requires immense upfront capital.
Billions of dollars.
Exactly. The fixed costs to run these factories, like the clean rooms, the power, the massive equipment, they're relatively stable. But because memory chips are currently in such desperate short supply, the prices buyers are willing to pay are just skyrocketing.
Oh, right. Murray Asset notes a 55% jump in DRAM average selling price in just a single quarter.
Right, so once a company covers its fixed operational costs, almost every extra dollar from that price increase translates directly into pure, unadulterated profit.
So it's an incredible moment for them, but there is a massive storm brewing on the horizon. The Euronext article highlights a very sobering warning from SK Hynix CEO Kwak Nojing.
Yeah, he did not mince words.
No, he didn't. He went on the record stating that 2027 will see the worst memory shortage in the industry's history. He's projecting that demand will outstrip global supply well beyond 2030.
That is a terrifying prospect for the broader tech industry, honestly. You can build the most advanced AI data center in the world filled with thousands of processors, but if you don't have the memory chips to feed data into those processors...
It's useless.
Exactly. Your state-of-the-art facility is just a very expensive empty warehouse. The software revolution is about to hit a concrete wall.
Which means the race is on to pour more concrete. According to the TrendForce report, SK Hynix is throwing down a fresh $15 billion, that's 21.6 trillion, won into their youngin' fab.
They are aggressively securing advanced extreme ultraviolet lithography and HBM capacity.
And they're pushing construction timelines so hard that they've actually moved the launch of their first clean room up from May 2027 to early February 2027.
Putting that $15 billion into perspective really requires looking at the broader competitive landscape. TrendForce gives us a great comparison of how capital is being deployed across the big players. Take Samsung, for example.
Okay, what are they doing differently?
They use an integrated model. They house their memory manufacturing and their logic foundry operations all within the same massive industrial complex in Pyeongtaek.
So it's all under one roof.
Right. The benefit is they can do complex 2.5D packaging all in one place. But the downside is institutional inertia. It is incredibly difficult to rapidly reallocate those shared power, chemical, and human resources purely to HBM when the market suddenly demands it.
Oh, I see. Then you have Micron, who is taking more of a geographically diversified approach. They're building new sites in New York and Idaho, largely to take advantage of U.S. government incentives, right?
Yeah, and to mitigate geopolitical supply chain risks. But breaking ground in multiple new regions takes immense time. They are going to be stuck in ramp-up mode straight through 2027.
Whereas SK Hynix's strategy in Yongin is entirely different. It's highly specialized. They are building a site from the ground up dedicated almost entirely to next-generation DRAM and HBM.
It's a hyper-focused, single-site base designed to do one specific thing faster and better than anyone else on the planet.
Is this just an AI infrastructure bubble, though? I mean, I have to push back on this strategy for a second. Samsung is trying to build the entire tech city, while SK Hynix is just building the highly specialized, ultra-expensive toll road for AI data.
That's a good way to put it.
But what happens if traffic slows down? Software and AI models are infinitely flexible. They can pivot overnight. But SK Hynix is locking $15 billion into rigid concrete, steel, and hyper-specialized equipment.
If AI development hits a plateau, they are left holding a massive, hyper-specialized factory.
Exactly.
Well, the executives at these companies are acutely aware of that physical risk. Building a fab isn't just expensive, it is notoriously error-prone. That's why they aren't just trying to build faster, they are fundamentally changing how they build.
How so?
They are attempting to remove human error and inefficiency from the construction and operation of these fabs before the foundation is even poured.
But building a highly specialized $15 billion factory from scratch usually takes the better part of a decade. If they need it online by early 2027 to beat this historic shortage, how do you compress a decade of optimization into a few months?
You have to simulate the reality first.
Okay, so this brings in the June 2026 multi-year partnership between NVIDIA and SK Hynix. On the surface, they are co-developing next-gen memory for NVIDIA's upcoming hardware.
Right, like the Vera Rubin supercomputers, the Vera CPUs, and the Jetson Thor robotics platforms.
But the real breakthrough is happening on the manufacturing side, isn't it? SK Hynix is utilizing NVIDIA's CUDA-X libraries and a framework called Physics Nemo to accelerate their semiconductor simulations.
Exactly. And the use of NVIDIA Omniverse here is what really stands out. They aren't just looking at CAD drawings or spreadsheets. They are creating fully autonomous digital twins of their physical fabs.
Wait, so it's a perfect 3D virtual clone of a multi-billion-dollar factory?
Yes. And to understand why a digital twin is revolutionary, you have to look at the mechanisms of a modern fab. A semiconductor fabrication plant is arguably the most complex manufacturing environment on Earth.
I can imagine.
You have precise chemical processes happening at the atomic level and hundreds of autonomous mobile robots moving delicate wafers worth millions of dollars around a massive clean room. Physics Nemo isn't just generating a visual blueprint.
Right, it's more than just a 3D model.
Much more. It is simulating the actual physics and chemistry of the chip-making process, calculating how gases flow in chemical vapor deposition chambers at a molecular level.
That's insane. And what about the physical logistics? How do they manage all those robots?
That's where NVIDIA's QOpt comes into play. It's a decision optimization engine. In the physical world, if two autonomous robots meet at a choke point in a hallway, production halts. It costs time and money.
Oh, for sure.
But in the digital twin, QOpt maps millions of different traffic patterns, equipment layouts, and workflow schedules. It simulates the movement of every robot over months of operational time.
So it finds the exact mathematical ideal for efficiency, identifying and eliminating bottlenecks before a single physical robot is unboxed.
Exactly.
I mean, can you imagine building a perfect virtual clone of a multi-billion-dollar factory just so an AI can teach itself how to run the real one? It is literally a digital illusion creating a physical reality.
In the digital twin, you can fail 1,000,000 times for free so that when you build the physical fab, it works perfectly on day one.
And with SK Hynix, armed with a highly specialized factory design, completely optimized by a digital twin, they are poised to dominate the AI hardware space. Naturally, everyday investors in the United States want a piece of that action.
Of course they do.
Which brings us to the financial mechanics of how we actually trade this reality. In July 2026, SK Hynix made its historic NASDAQ debut, marking the largest ever stock listing by a foreign company. The stock opened at $170 under the ticker SKHYV after being priced at $149, and it jumped 15% by midday.
A massively successful debut.
But I have a fundamental question here. You can't just log into a standard U.S. brokerage account and easily buy shares directly off the Korea exchange. So how did U.S. retail investors actually buy into SK Hynix?
Well, the barrier to entry for international investing is massive. You have currency conversion fees, entirely different foreign clearing systems, and complex tax jurisdictions.
It's a nightmare for an average investor.
Exactly. To bypass this, global finance uses a specific wrapper called a depository receipt. The ESMA paper we looked at provides a fantastic breakdown of the mechanics.
Okay, lay it out for us.
A depository receipt, or DR, and in this case, an American depository receipt, an ADR, is a negotiable certificate issued by a local bank that represents shares in a foreign company. But it is traded entirely on a local stock exchange.
So think of a DR like a high finance co-check. You, the foreign issuer, hand over your actual South Korean stock to a major global depository bank. They lock those original shares in a vault with a local custodian in Korea. In return, the bank hands out American tickets, the depository receipts that represent those shares. And you can trade those tickets at the NASDAQ party all day long in U.S. dollars using the local clearing and settlement systems you're already used to.
The logistical mechanics make the world feel entirely borderless. The investor gets the economic benefits of the underlying shares, like the price appreciation and the dividends, without ever touching the foreign jurisdiction.
So the bank just handles all the messy stuff.
Yeah, the depository bank handles all the conversion of dividends from won to dollars, distributing the cash directly into the investor's U.S. brokerage account, taking a tiny fee for the service. It seamlessly abstracts away the friction of global trade.
It sounds like the perfect system. But wait, if I have the American ticket for the Korean stock, what happens if the country holding the actual stock in the vault suddenly goes offline? Does that layer of abstraction ever just break?
It absolutely does, and the fallout is severe.
Okay.
The ESMA paper details exactly how this financial plumbing shatters under geopolitical stress. If we look at the 2022 Russian invasion of Ukraine, just purely from a regulatory mechanics standpoint, we can see how the illusion of safety provided by a DR evaporates.
Okay, so what exactly happened?
Well, prior to 2022, DRs on Russian shares were widely sold to both institutional and end investors across European markets. When the invasion occurred, EU sanctions immediately forced the suspension of trading for these DRs.
Okay, so trading halts. You can't buy or sell your coat check ticket, but you still own the coat, right? What was the next sequence of events?
That is where the legal trapdoor opened. The Russian legislature enacted a countersanction known as Law Number 114FZ.
And what did that do?
This law legally mandated Russian companies to terminate their DR programs with Western depository banks.
All right.
So the Western banks holding the underlying shares were suddenly told by the Russian government that their depository agreements were null and void. The vault was legally sealed.
Wow. So you're holding a ticket for an asset that the local government says your bank no longer has the right to access. Did the banks try to fix it?
They did try a workaround to preserve the asset rights of the EU investors. The depository banks proposed an exchange, basically, hand in your frozen DR, and we will give you the direct, raw, ordinary shares in the Russian company.
Okay, that makes sense. Cut out the middleman.
Right. But to facilitate this without violating sanctions, the depository bank would open a nominee account with a non-sanctioned Russian bank, like Gazprom Bank. The hope was that investors would at least physically hold the asset rights for the future.
But I'm guessing it wasn't that simple.
No, it collapsed under the weight of competing jurisdictions. First, the EU's sixth sanctions package effectively blocked this exchange.
Why?
Because the rules strictly prohibited any transactions that benefited Russian entities, which included the Russian Central Security Depository. When that failed, Moscow offered a solution termed the Russian way.
The Russian way? What was that?
Investors could apply directly to the Russian depository to force a compulsory transfer of their accounting rights. But European notaries refused to certify the necessary identification documents, citing EU sanctions.
Oh, wow. So you're just stuck in limbo.
Mm.
And the United States stepped in as well, right? There was a specific SEC rule that hammered the final nail in the coffin.
Yeah, the SEC issued Order A2090. Because these DRs had plummeted in value due to the trading halts, they automatically fell under the classification of low-priced securities, or LPS rules.
What are those?
They are essentially penny stock regulations for securities trading over the counter for under $5. The mechanism behind LPS rules is designed to prevent extreme market manipulation and volatility.
Oh, I see.
You can't just allow millions of legally dubious, newly untethered penny stocks to flood the U.S. market. The SEC heavily restricted conversions and trading of these securities to protect the broader market integrity.
So the system slammed shut from every possible angle. The beneficial investors in the EU and US were left with immense ownership uncertainty, frozen assets, and completely blocked dividend payments.
It was a mess.
The coat check ticket became utterly worthless because the building holding the coat was condemned by competing governments. It is a sobering realization of how fragile financial abstraction really is. We constantly build complex layers to manage reality. A depository receipt abstracts the reality of foreign ownership. A digital twin abstracts the physical reality of a semiconductor fab.
And we rely on these virtual layers to function in a complex world. We crave the abstraction because the raw reality is either too slow, too legally complex, or too risky to deal with directly.
Which brings us perfectly to the final and definitely the most unusual piece of our source stack today. We've seen how financial abstraction can melt away under geopolitical pressure and how digital abstraction is being used to build the physical factories of the future. Let's look at literal human illusion.
Yes, the magic show.
Exactly. The Fast Company article details a massive new magic venue in Chicago called the Hand in the Eye. Think about what we've unpacked today. In Chicago, someone spent $50 million to create an environment purely for human illusion. Meanwhile, in South Korea, SK Hynix is spending $15 billion to build physical factories, guided by the illusion of a digital twin, all to manufacture the chips that power the magic of artificial intelligence.
And on Wall Street, investors are trading the illusion of stock ownership through a depository receipt.
Right. So let's talk about this venue, a fascinating pivot. Venture capitalist Glenn Tullman spent $50 million to convert the historic McCormick Mansion on Michigan Avenue into a 35,000 square foot immersive space dedicated entirely to mid-century Chicago-style close-up magic.
The physical details of how they constructed this space are incredible. This building used to be a Lowry steakhouse, very traditional, very grounded.
Now, the design by Rockwell Group and Pentagram is engineered specifically to disconnect you from the outside world. You walk into the lobby, a large wooden door slides open on its own, and you enter a room with a ringing vintage telephone.
Oh, that's creepy but cool.
When you pick it up, the experience begins. There are strict no-camera rules. Tickets are $225 for a 3-hour experience. The interior uses rich wallpapers, marble bars, and endless velvet to create a sensory deprivation effect from the modern world.
It's designed to feel like a permanent 10:30 p.m. inside. The entire architecture of the building is engineered to make you suspend your disbelief.
It is a $50 million temple built to celebrate the human desire to be fooled. Whether it's a card trick, a financial instrument, or an AI simulation, humans constantly build complex layers of abstraction to manage, understand, or profit from reality.
When a magician performs a card trick, when they manipulate pieces of waxed paper right in front of your eyes, they are actively overriding your brain's physical understanding of reality. We gladly pay good money to step into that altered reality because the illusion is more entertaining and manageable than the truth.
When you connect the dots between all our sources today, a really profound narrative emerges for you. In Chicago, a venture capitalist spent $50 million to create a physical environment entirely dedicated to human illusion. A place where people gladly pay to escape reality.
Yeah.
Meanwhile, across the globe in South Korea, SK Hynix is spending $15 billion to build physical factories. But the design and operation of those physical factories are entirely guided by the illusion of an omniverse digital twin. They're building virtual clones to figure out how to manufacture the physical chips that will power the magic of artificial intelligence.
And tying it all together, on Wall Street, investors are pouring billions of dollars into trading the illusion of stock ownership through a depository receipt.
Yeah.
It's a financial ticket that feels real, that deposits dividends like it's real, until a geopolitical crisis reminds everyone that the physical share is actually locked in a vault thousands of miles away, subject to laws they don't control.
It really is the exact same mechanism,
Yeah.
just applied across different sectors of human ingenuity.
Mhm.
Whether it's a magician's sleight of hand in a velvet room, a virtual simulation of an autonomous robot navigating a clean room, or a banking certificate standing in for foreign equity.
Right.
We are constantly constructing digital, financial, and theatrical illusions to help us wrangle a reality that is otherwise too complex, too distant, or just too slow to deal with directly.
We absolutely need the proxy to make the modern system work. You simply couldn't build the Youngin fab fast enough to meet the 2027 memory demand without the digital twin simulating the physics first.
No way.
And you couldn't raise the global capital required for that massive build-out efficiently without the depository receipt abstracting away the clearing systems. And maybe you can't survive the stress of modern global finance without a good magic show to remind you that sometimes it's okay to just be fooled.
So, to quickly recap our journey today, we started with the brutal physical constraints of the impending 2027 memory chip shortage and SK Hynix's massive pivot to build hyper-specialized $15 billion AI factories.
We looked at the underlying mechanics of how they are using NVIDIA's Physics Nemo and QOpt to simulate that physical reality before they pour the concrete.
We then explored how global capital accesses that growth through the convenient but ultimately fragile wrapper of depository receipts. A lesson learned the hard way by investors navigating the legal trapdoors of the 2022 Russian sanctions.
And finally, we looked at a $50 million mansion in Chicago dedicated entirely to the art of human illusion.
Which highlights a profound shift in how we interact with the world. We are increasingly comfortable operating within the proxy rather than the source.
Yeah.
As our global supply chains, our financial markets, and even our manufacturing processes increasingly rely on virtual replicas and financial abstractions, we have to ask ourselves a difficult question.
What's that?
How long until the digital twin of our global economy becomes more valuable and ultimately more vulnerable than the physical one?
And when the servers finally go down, or a geopolitical vault slams shut, and we can no longer tell the difference between the physical asset and the digital illusion, wait, well, what exactly are we left holding?